So
It's not FMC slowed down a bit now, isn't it? After that massive move earlier.
yeah, it's still pushing, but momentum in there, is it?
Yeah, sure. I mean, he hasn't said anything else now, but so yeah, basically, I don't know if many of you saw our post on Instagram, like it was either yesterday or before, where we kind of it's a brief mention about currency correlation because I don't think we talk about specifics when it comes to like the oil market and the gold market as well, but I think we talk about like the actual correlation between pairs and like how strong they can actually be and how we can sometimes I can see like the market what's going to happen in the market based on one market. So I feel like that's what we briefly want to cover today. It's not something you can have a base strategy of simply because nothing's not ever certain. These correlations do change because obviously correlations don't stay the same all the time. So, but it's definitely something you wanna know just going forward because when you like let's say you're trading GU and then you want to enter EU as well. That's those two pairs are most of the time they're very close correlate together, which I'll show you in a minute. Like because obviously like the pound is still like part of Europe anyway, not in the European Union, but still closely linked to the movement of the euro. So anything that happens, obviously, and then you're looking at when you're looking at euro dollar, and then you're looking at pound dollar. Whatever euro dollar does, as it's the main trade, well, the mostly traded currency in the world, the pound dollar will follow that, and that's when you look at currency pairs. So you wanna look at one strong pair, like one really heavily traded pair, and then like a pair which is not as heavily traded but still contains one of the currencies. So just a quick example, you'd look at obviously euro dollar, and then you look at euro yen, and then you look at pound dollar, pound yen. You know, anything with yen pairs, anything with dollar pairs, as long as the same currency is there across both of them. So what I wanted to briefly cover is, so if I know yesterday we've had a bit of a rocky day on euro. Let's go on the hourly, actually be much easier if my screen loads. We working fine, not leaving it now. So. But yeah, another aspect that comes into this is obviously like your risk exposure, because if you're entering position on Eurodollar, let's say 2% risk, and then you're entering like you're buying Eurodollar, let's say, and then you've got another buy order to buy pound dollar as well, you're like essentially at the end of the day, you're doubling down your risk because you're trading with two very, very closely moving assets. So chances are, if one of them doesn't go to target, the other one won't either, or worse yet, it'll take you out because the market's going to turn around. So you do need to be very careful when trading like two very closely linked assets, and also be aware of any news that's going to impact obviously both of them. So for example, if like this FOMC today, if we look at any chart, I mean, I've only got 4 that we trade here, but if you look at any chart, it's going to be like the same situation across all of them. Obviously, the candles aren't going to, so on that euro yen, the candle isn't as big as on euro dollar, but the market is still going to be impacted in a way. So this also drills down to when you actually like, so for example, if Key and I were to enter a position on euro dollar and then pound dollar, and the setup was exactly the same, we'd never enter two orders. We never go, right, we'll do 1% in this market, 1% in this market. We'll look, and we'll take forever sometimes just to drill down to the perfect asset, to the perfect like currency to trade, simply because we don't want to just expose ourselves to risk. Because you're like, if I'm trading pound euro dollar on with 1%, and I'm trading pound dollar with another 1%, that's 3 different currencies there. So anything can go wrong in like one of these currencies, and ultimately I'm going to lose out on 2 trades there. So you want to like, sometimes you just want to be certain and actually enter that one position so you don't get stopped out. Let me just find another thing here. Load. So yeah, so if you just and then if you ever want to actually compare any pairs that you're looking at, you literally just go compare on TradingView and then type in the pair here. And what you want to press is your new price scale, as this will give you like what's the word I'm looking for? It'll give you the best representation of the two markets together, so it'd be clearest to see basically. So if I just, and then automatically you get I think the orange colors, like the default colors. You can compare on the first version of the Pro TradingView, you can compare up to 2 or 3 currencies, I think. Okay. I know it's not going to match like perfectly, but if I literally just leave it like here, you can see how closely. So obviously my main currency there is the euro dollar, and then the second currency is the pound dollar. So if you look at the highs and the lows, most of the time they are in the same area, or their highs are definitely in both the markets. So like here, for example, a high's been made, and then like literally a few hours later, the same high is made in pound dollar. And then since then, the market just moves downwards simply because how closely correlated these pairs are. And to know, because sometimes you might be trading, you might have a trade open in the euro dollar, and then you see the pound dollar, like, let's say if I'm going long. So if I just get rid of this, let's say I'm going long in this market from there, like whatever. And then all of a sudden you see the pound dollar going down. So like as soon as this happens, so if the pound dollar suddenly starts coming down, I know it's a euro dollar to chart, but just imagine I've got the other chart open here. Let's say the pound dollar is doing something like this. So it's gone up here, and all of a sudden it's coming down, but like the euro dollar still going up. In that moment, you might find it useful to check. There's an indicator which is called the correlation coefficient. It's like a simple maths term, and what it does, just type in what currency you want to compare it to. Oh, I've already got one, don't I? So what it does is it gives you how strong the correlation is between the two pairs. So what it means is 1 point move in the base pair. So 1 point move in the euro dollar will how far 1 point move in the euro dollar is going to affect the pound dollar. So most of the time you can see here it's around 1, which means perfect correlation. So a 1 point move in the euro dollar is going to cause a 1 point move in pound dollar in the same direction, because it's a positive correlation. And then the same thing applies when we look at negative correlation. So you can see, like, most of the time this market is very heavily correlated. As you can see here, it's like these figures are touching 1, but sometimes you do get these dips which don't last long, but they do happen in the market. So what my point is, sometimes when you are in a position and you see, oh shit, and you see, like, as I was explaining earlier, you see like pound dollar, like a strong pair which is correlated to the euro dollar trade downwards. You might be like, oh, I need to get out of this position now because the same thing's going to happen to euro dollar. That's where you take a step back and actually, like, you can use this tool to compare correlation, because if they are heavily correlated, like they were here, for example, chances are the euro dollar is just lagging and it's waiting for that push downwards as well. But if they're not, so if it's a negative correlation, it means like markets are out of sync. So you don't have a reason to get out of the market now, because chances are the pound dollar, it will catch up to the euro dollar, because the euro dollar is the more traded currency. So it's more dominant essentially. And yeah, so these like this pair here, the pound dollar will be correlated to euro dollar, and then the same thing if I look at obviously pound dollar perfectly correlated, pound yen. So pound yen, like another good example there. You can see most of the time we're near perfect correlation, and then sometimes like this we had a big dip here where it was negative correlated. I couldn't tell you why that happened for a reason, but if you have a look at the chart here, as you can see, most of the time it's the market is going upwards. Obviously some highs will be different than other highs. Like for example here, there's a high made in pound dollar, and then it's a lower high there, and then on pound yen we've got a high made here, and we've got a higher high there, and then like this is a divergence. Like this is the like Key will talk about like this in a minute anyway, but this is like if you had an indicator, this would be like a divergence on the indicator, which is signaling a movement downwards. Like the markets are out of sync. There's one market is making a lower low here, and the other one is making a higher high there, which suggests a possible move downwards here. So, and that's exactly what's happened there. But that's not going to expand too much on that concept because I haven't developed it enough yet to teach it myself, so to teach it to you guys. So what I want to do is learn it more, and then actually start incorporating it into strategies. Because if you can see how one market's catching up to the other market, like in real time, it's much easier to actually enter positions because you can see where the stops are being taken in one market, like compared to the other market. But yeah, so and if we look at actually a market which is negatively correlated, so for example, if I go on euro dollar and then load, you can change this correlation coefficient here. So you just need to change the input into whatever you want to do. So if I go US 500, so you can see much bigger movements here, but generally like we have a strong positive correlation there as well. Sometimes you do get these dips there, and then the market does like eventually catch up. Let's have a look actually on if I change the input on here as well. So you can see here what's happened. So we've got a downtrend here, starting a downtrend. So as the downtrend starting, we can see like the correlation is very positive, but then it kind of makes a bottom there, and then the E doesn't make a bottom itself as it just carries on this downtrend. So as it carries on this downtrend on EU, if I just move this here so it's clear. So yeah, as this downtrend continues, you can see the S&P like carries on its uptrend, and that's where like the negative correlation peaks there, because that's where the market's telling you, okay, these markets aren't like positive correlated as they normally are. So one market's either going to have to push up or the other market's going to have to push down. And most of the time what we see is like the dominant market. So let's say if I'm trading EU and I see got negative correlation with the S&P 500, what I'm expecting is the S&P 500 to correct itself to whatever like EU's trading at. It's the I think, how do I try and get my words together so it makes more sense? Yeah, I feel like it comes down to the same principle again. Like once you're in a trade, and let's say you're either in profit or in a loss, and you see like another pair is not trading like as it should be, as the general trend of that pair is normally trading. That's where you do need to take a step back and actually like either analyze the currency on here, so as I've done there with like how they normally operate, and then get the correlation coefficient up as well, which is what I do personally, as it gives you like a rough idea of how long this currency can stay out of sync with the base currency. As you can see here, like normally it's a few hours on here, and then but on stronger pairs, like we went through the pound dollar example, on the stronger pairs, like it's normally like a few hours like of the day at max, where the euro dollar is not going to be in sync with the pound dollar, because it's like that's where that's where these stop rates happen. And that's what we're like explaining more depth. Like I know we'll explain this in more depth in our course. But that's where the stop rates do happen, where the market literally pushes price where it needs to push price to get those orders in. And then, yeah, if we look at something that's really negative correlated, so we know from risk flows, the S&P 500 is really negative correlated to the US dollar. I've got loads of things in here. Hang on. As the US dollar is so yeah, as the US dollar goes up, obviously the S&P 500 will go down and vice versa because of risk flows. So what I expect to see when I open this chart is, first of all, let's just close this, a really negative correlation. So as one goes, like simply looking at it, as one goes up, the other one goes down. As you can see here, we've got as you can see here, we've got a bit of an uptrend there. And if I actually zoom out, there's like times here where, yeah, we do get a positive correlation once again, but the overall trend is like massively negatively correlated, because that's what we expect from risk flows. So sometimes you can enter a position where the stock market opens in the US, let's say, and as the stock market opens, you can see like a massive move in the euro dollar, for example, and that's where the risk flows kick in. So if the stock market opens and euro dollar starts flying up, as like you see, let's say you see the S&P float, for example, chances are on days where the euro dollar is positive correlated. So let's say here, like you can see a massive 0.9 correlation, which is quite big. So for a few days there, it stayed positively correlated, highly positive correlated to the euro dollar. As you can see here, like the euro dollar moves upwards and the S&P 500 moves upwards as well. So yeah, if you see S&P like 500 open and it all opens at all-time high, chances are euro dollar will also be like not going for the all-time highs, but what I'm trying to say is it will continue on that uptrend as the S&P is on an uptrend as well. So I think that covers like the basic correlations. I don't want to go into too much depth because it gets quite confusing as to where the actual divergence can occur, as it's like, once again, based with like covers liquidity, but it's like a different aspect of it. So I'm not going to go into too much depth. But what we want to kind of get out, I think, today was just like to be aware of these coefficient, like correlation coefficient, like of the correlation coefficients and the correlation between the pairs as markets move closely together, like a lot, and you need to be aware of this move. That's why like in our morning routines, we always stress you check different markets and you check what's happening in different parts of the world, because you'll be surprised how like perfect example, how a job role statistic like the NFP every month affects like the pound. Yeah, it does, because all these markets are very closely correlated. So you need to be aware of like what's going in the markets, basically. And then obviously we have just the basic commodity correlations as well. So we know like if I just quickly go on, where is it now? I've been on this watch list for ages, USD CAD. If I just show you like a quick correlation, obviously we know the Canadian dollar is highly linked to oil, as oil is the main export, one of the main exports of Canada. So if I just type in oil, so once again, what we can see from here, so US dollar and Canadian dollar, it's negative correlated. Why? As the price of oil increases, you've like the Canadian dollar will increase in value as well, and as the US dollar is the base currency, it will drive the correlation coefficient down. So the correlation coefficient is going to be negative, as the Canadian dollar is the second currency. But if I look at, for example, CAD yen, it's going to be the opposite situation. So we are expecting, as it's the base currency, as the price of oil goes up, we'll be expecting CAD yen to go up as well. So, and And the same, like we can observe the same thing with gold and the Aussie dollar as well. But the currency there is not as strong as it used to be, and it's quite volatile at the minute because, I mean, the price of gold is not really moving anywhere. But yeah, that's on like the coefficient, on the correlations. That's pretty much it for now. And then I want to find the graph actually.
You finished, Chris? I'll switch over.
Yeah. We'll swap, and then like after you've done your bit, I just want you to show you a graph.
Can everyone see my screen? Okay, so my section's actually not that big now after what Chris has said, because he's pretty much took everything that I was going to cover and spoken about it already. But yeah, I was just going to cover the currency divergency. So in essence, this is where we're looking at those correlations and when we spot a divergence. So if you don't know the meaning of divergence, it's just, well, I don't know the actual definition, but it's when things start moving against each other. So like, let's say they should both be moving up, but then there's a divergence because one's moving down, one's moving up. That's sort of the basics about behind the concept. But this cross-currency divergence is really nice for trading fractals and liquidity traps. Probably more so liquidity traps, but I've got a nice example of where we find an order block from this divergence along with the liquidity trap. It's a beautiful area. And it's an area I highlighted to Jake the other day when we was talking about setup. And then overnight it pinged into this area and flew off, but I'll show you that in a minute. But essentially, when we're looking for divergences, we're not looking for like Chris said, we're not looking to trade them as a strategy. It's not, I mean, I suppose you could, there'd be a lot of testing that you got to do sort of around it, but that's not what I'm looking to do. I'm just looking to get it as a nice confluence when you're taking a sell. So on my screen, I've got cable, and then below I've got euro dollar. So all I'm looking for here really, and I mean, you can do it just by looking at the tickers in your watch list. You can sort of tell which one's up, which one's down. But you can't always tell with these sort of high highs, high lows, lower highs and stuff. So the basics of this, I mean, this was only a few days ago, the 4th of March, so last week, I think, or the week before. And we're on the hourly time RAM as well, but we'll scale in a second. You can just see, obviously, we've made these two highs. Now, they're not clear like swing highs. That's not what we're looking for. We're just looking for points on the chart where there's divergence. So like Chris said, usually euro dollar's the leader. It's pretty much just because it's the most liquid currency. It's where people go first usually. Obviously there's traders that will trade cable and not euro dollar. I'm not saying that, but because there's so much liquidity in euro dollar, it usually runs the race unless there's, I don't know, a catalyst for the pound or something. Yeah.
Emphasis on usually, like, it doesn't always do that.
Yeah, if there's like a catalyst for the pound, for example, like news or just market sentiment, obviously that's not the case. But so yeah, so you can see anyway on cable we've come up and we made a higher high, but on euro dollar what we've actually done is we've sort of been trailing to the downside. Now with what we know in mind about euro dollar being more liquid and sort of leading the race sometimes, obviously it's not fail safe, but we're actually on track to the downside on euro dollar. But then what do we have on cable? Anybody who's been with us for some time knows exactly what this setup is. It's a liquidity trap or an SFP. Now we can look at this, and I mean, you're not always going to have a chart of euro dollar underneath, but as these candles forming, you can start looking at what euro dollar's doing, what other pairs are doing, what the dollar index is doing. I've only just found that you can actually put this chart without, I don't think you need the paid version either of TradingView. You just click compare and then add it as a new scale. So I'll do it. So I'll show you how I do it. You are.
You can have one like indicator or like one extra tool, I think, on TradingView without paying for it.
Okay.
Because we're free.
Yeah. So we just click compare and then click euro dollar or whatever you want. But instead of putting if you put same in scale, it's going to pop over the top, and then it does all this in percentages. You can't change, like, move your chart and stuff, which is good for comparing price action. But for the purpose of this, we want to add it as a new pane. So like I say, it comes up below and it's going to come up as a line like this. And I did have all my divergences drawn out, so that's a bit of a bummer, but just change it back to candles and we'll scale back in on this divergence here. So now what we know about liquidity traps is on the close of this candle, or potentially closer to the level, because let's check how many pips. I remember it's cable, so it moves a little bit more. 9 pips away, yeah. So we're going to put our entries a little bit closer to the level of liquidity with ATR, not ATR, sorry, wick +5 stop, and then for FTA will potentially be somewhere around this level. We've got some nice candle closes and the candle open there. So we could have traded that with using the liquidity trap method. It looks like we're pretty much in and out of that within 15 minutes, I would say. Yeah, it's a candle close. Okay, so within half an hour anyway, you'd be in and out of that position. But it's such a nice confluence that euro dollar's leading to the downside, and then we come up and we take liquidity above this high. So if it is a laggard and it is going to follow euro dollar, obviously we come into the downside. But what's it doing? It's taking the liquidity before we have that move. So it's just a really nice confluence for us to sort of see the longer term buyers to the downside. But then, like always, who's going to have the bollocks to step in front of this move? Us who trade liquidity traps are, so there's not going to be a lot of what was I going to say? There's going to be a lot of liquidity there. People who are in profit and they're just going to get taken out. And I mean, me personally, I'd be happy to stand in that regardless of the divergence, because it's a nice setup. But just having that divergence there is just really nice. You can do it with the dollar index as well, but pretty much with euro dollar and pound dollar, you're literally going to see the chart flipped upside down. Especially euro dollar is pretty much with the DXY anyway, not the dollar index as such, but with the DXY it's 80% weighted to the dollar or 70% weighted to the dollar, one of the two. So it's pretty much the chart flipped upside down. But then this area that I marked out to Jake the other day was this order block. So we've got a 15-minute order block here, the candle before this massive push to the downside, which obviously breaks not only the short-term market structure, but it breaks these longer-term lows down here. So this was an area that really interested me. Now, I didn't trade off it pretty much because the move happened in the middle of the night, but I can't remember what we was talking about, but me and Jake was talking about this chart, and we said something, and I said it's going to come up and tap 140s. There's a nice order block here, and then it's going to crap itself to the downside. And the next few days, literally come up in the middle of the night, straight into this area, touch 140s, couldn't close above, and then just shot to the downside. But yeah, it all originated with this area where we had this cross-currency divergence. So I'm not saying that it's going to be that clean every time, but that's just a recent example. Like I said, it was on the 4th of March and 3rd of March, where we have an example of a cross-currency diversion with an LT. You could have traded it as a fractal as well. If you couldn't have used the OTE because this is like a week later, so you wouldn't have used entry. But you could have potentially, if you'd have traded the order block, you'd have the lines that are like that. But you could have traded what looks to me like a launch pad, something like this. And you can leave these orders in for a few days, like they're still valid. So yeah, that's just a really nice setup, and something you can use going forward. Now I've just got another couple of examples. There's not much more to go over. I'll speak about just looking at your watch list as well in a second, but it's not a massive sort of topic. But again, you can see obviously euro dollar's making higher highs, whereas the pound dollar is making lower highs. Now again, it's not so clear, and you have to sort of know what you're looking for to know that there's a divergence there. But then what do we have after? This is a classic bearish divergence, whether you're using it on the RSI, MACD, whatever indicator you're using it on, or oscillator. Even if you're doing it, like I say, against two charts, it works the same. So it's bearish divergence, and then we have a push to the downside. I don't actually think we come up for a retest on cable yet. But again, this might be a nice area up here around 141s, 142s. We might have some nice order blocks up here, potentially here, somewhere around here. Look at something like that because we're on the 15-minute. An area like that price might come up, tap 141.6 and then drop. Here we've got now I've outlined that, but I can't actually see it myself. Yeah, I think I was looking at something wrong there. I can see another I used to trade divergences as well. So I used to do this quite a lot using the RSI. I mean, you can make money from it. It's not mad profitable. Like some of the setups you get are like, you're either really wrong or you're really right. Strike rate's not great, but the moves that you get that are right, you usually get pretty beefy moves afterwards.
Yeah, if you combine it, as you said, with different strategies, you can definitely catch some big moves.
I mean, it's not a liquidity trap, but I suppose you could trade it as a liquidity trap if you allow for this close above. I wouldn't personally. I wonder if you could get a fractal in there. No, you just missed entry on a fractal unless you held it there, but then you'd get stopped out afterwards. But obviously euro dollar would be moving up as well, so the divergence is gone. But you sort of get the point. It's just looking for these spots on the chart where price isn't, like Chris has said, price moves with correlation amongst these pairs. And this is not just sort of native to euro dollar and pound dollar. You can do it euro yen, pound yen, euro dollar, euro yen, any sort of pairs that usually move in tandem with each other. But you tend to find the best is like euro dollar against pound dollar and euro yen against pound yen, because it's like the safe haven currency is there on both, as opposed to doing euro dollar and then euro against a different safe haven, in my personal opinion. But then lastly, about divergences, something that I do usually just to have a look at, if I can't really see anything or I need sort of guidance with my daily bias, is I'll just look at euro, pound and dollar yen, just to gauge sort of which safe haven is stronger than the other. If the dollar's stronger than the yen, pretty much we're going to see pound dollar down more than pound yen. Yeah, that's right. Because it's going to be pressured more. And if it's not, there you've got a cross-currency divergence. If dollar's up against the yen, but then the yen's outperforming the dollar against these pairs, there's going to be a short-term correction, and you might find that the pound dollar or euro dollar is about to crap itself or about to fly, depending on what way the divergence is going. But it's not a big enough sort of topic for us to go over in terms of adding to your arsenal, because it's something that we look at and we sort of gauge an idea of market sentiment, but we don't usually add it. I mean, this I would add as a confluence. I would look at that, and if I was trading this as an LT, I'd look at that and I'd be like, okay, we've got a cross-currency divergence to add to a confluence, and I would add it. But it's not enough for me to be like saying, do this every day, have a look at these divergences every day. But when you get them, along with, like Chris said, if it coincides with your strategy with a fractal or an LT, like it's really nice. If you're coming back to entry on a fractal, let me see if there's one here, because it would be absolutely perfect if there was. Where's price action? Okay, there's the sort of one. It's not great, but there is sort of one. You can see we're sort of stagnant up here, and we do make a lower high. Whereas within the 15-minute order block on cable, we actually make a higher high. Again, that's a bearish divergence. And then what do we see afterwards? We see it plummet. And then yeah, it's just a really nice confluence if you're looking to take a setup or looking to get an entry. But that move happened at 1 in the morning, so I wouldn't have caught that anyway, unless you'd have left the pending order. But yeah, that's pretty much everything I wanted to speak about in terms of divergences.
One last thing. How do I show on screen? Oh. Do you want to continue? Yes. Kick you off, sorry. One last thing, like just to make sense of everything we're kind of saying, if you go on a MyFX book, there's a currency correlation calculator, and you can like select all the pairs you want to compare basically, and then the time frame you want to compare. I mean, just for the point of the example, like on the hourly, you will see some correlations be completely off sometimes, just because of like events such as like news and then institutional money coming to the market, whatever. But if you actually go on higher time frames, so generally anything above a week, you'll see like these currencies be quite strong. Just for example, like if I look at euro dollar there, its correlation in the last hour with the pound dollar is only about 7%. But then if I actually go on a weekly, it jumps up to what, 90% now. So you can see like the higher the time frame you select, the closer the correlations will be together of these pairs. As we say, generally they do move together in the long run. And yeah, like like I wouldn't suggest it's something you look at every day, because you don't need to look at every day, but that's maybe once a week, once a month. If these correlations do change, then you're actually aware of it. And sometimes you can actually see like some random, like, to give you an example, I don't know, like sometimes you see some random pairs being correlated together, like, and I have no idea why they are, but it's just the way Forex works sometimes. And then yeah, like for example, USD Swiss will be like normally highly correlated with USD yen, because of the safe haven flows. And then just have a look once again. Euro dollar, strong correlation with the euro yen. Also like a really strong correlation with the Aussie dollar, for example. So, and you can see like as we said, the euro dollar is a strong base. A strong, very liquid pair, and very heavily traded. They'll have like strong correlation with most pairs. For example, like if euro dollar goes up, on normally the USD CAD goes down for some reason. So you can research these as well. So, but yeah, that's covers everything. And I hope it's not too much to take in. But any questions, lads? Does it make sense, like what we're trying to say?
Yeah, it's like makes sense to me. It's just identifying like those key areas Kieran was pointing out as well.
Yeah,
like
it's like once you start, you get used to. Well, you get used to once you see like a few, and you know like what the divergences are and like when they can occur. Because like trading divergences itself, like at the start, can be quite difficult. So you just need to like get to know the pattern itself before you start implementing it like across like the correlations. But we can obviously help with that as well.
I quite enjoyed trading divergences. It was just there's no sort of like trading them on their own. There's no sort of theoretical backing behind the strategy. Whereas if you look for a divergence along with a liquidity trap, for example, you're just upping your chance, because there's more chance that let's say euro dollar's just dropped 30 pips for no reason. There's no news catalyst, and pound dollar then forms a liquidity trap to drop to the downside. Well, our bias is already to the downside. Just having that divergence there just makes us think, okay, we might follow now. And it just gives you that extra little bit of sort of, I don't want to say confidence, but reassurance, if you will, to take the setup.
Yeah, I feel like that's the best way to put it.
Yeah, I don't want to say you need to be confident in yourself, because that's a given. You back tested it, you've traded it, you demo traded it. But yeah, it's the only word that fits the equation, really. Is there anything specific anyone wanted to go over tonight? Because it's not a massive topic what we've just covered, and I'd rather than us just finding something random to go over, if anyone's got any specific questions about the week or about anything that's happened or any setups or whatever, I'd rather go over something useful.